My,
One
my
more
name,
time, one more time.
yeah, sure. Yeah, my name is Dr. Rufaro. I'm glad to be here with you all. I'm very much an advocate of giving back to the community and helping folks wherever I can. With whatever resources, knowledge, or expertise that I have, I definitely enjoy sharing. So, thank you, Candice, for this platform and for always bringing people together. You're always, pulling people together, doing your thing. So, definitely appreciate your giftings in that. And yeah, so today I just wanted to share a little bit of some of the stuff that I've been doing, uh, particularly related to tax planning strategies. I have been doing this for myself and then blessed with family resources, as my mom alluded to. I learned taxes from her. Okay, so I actually learned how to do taxes from her. She helped me do my very first taxes, I think way back when, and we've all been doing our own taxes. We've never paid like anyone to do because of the family resources that were afforded between my mom and also my dad is a CPA too. So whenever I have those like really intrigued high level questions, some of us dip into entrepreneurship. Those are all my go-to. So we're just trying to share what we know so we can all win in 2025, right? We all want to win because there's a lot going on. Don't want to get into any political, activities going on, but we all know what's going on here,
We don't want to
right?
get in. We are here for it. This is team 92
Well, that's the
all the way
thing is that
around.
we're laser focused on moving forward how we can help ourselves because
Mhm.
we don't want to be so indulged in whatever is going on. We're so focused and we're just going to keep it moving because the truth is a lot of other racial groups, they've been winning for a long time. They've been sharing knowledge, they've been passing on knowledge to their generation, and there's a lot of information that is by default other groups just know. And so us as minorities, and not, excluding anyone who's not a minority, but we all want to share knowledge and win in 2025. So that's what this is all about, really. There's no hidden agenda behind this. It's just, hey, this is what I'm doing. I'm just sharing this because it's really working for me. And this could be a way for us to build wealth, long-term wealth, and also pay down debt. Because, we all know the deal of things that are going on in society today. So that's the purpose of today. I am going to share my screen. Let's see. It looks like I have to request that from you, Candace, so that I can share the screen so that we can jump because we want to maximize the time that we have today, so that we have a solid, about 40 minutes to an hour. I want to leave a lot of time for questions as well. So just let me know. Okay, there we go. It looks like I can now share my screen. So I'm going to share that. And let me know when everybody sees my screen. Hopefully can you see my presentation? Okay, it says tax planning strategies, thumbs up. Yeah. All
Yeah.
right, awesome, awesome. So we're gonna go ahead and get started. So tax planning strategies, how to legally pay less taxes. Again, keyword here is legally. We are not doing tax evasion. We are legally learning how to pay taxes, and save, and really learn what are the things that we can do. That there's a lot of things that are already available to us, and if we just learn how to leverage that and incorporate that in our financial goals, it'll go a really long way. So that's what this is all about. So this presentation will cover how to help lower your tax liability, keep it simple. We're not trying to overcomplicate anything, and then maximize your cash flow because that's what we need right now. We all need more cash flow. I think we can all agree. Amen. Amen. And then what you do with that cash flow is up to you. For me, it's paying off debt. Me and my husband, we have some goals to like really aggressively pay off debt, and so it's been helping us, at least since last year. So we're going to go ahead and get started with that. So we kind of covered a little bit, again, a little bit of intro about myself. My name is Dr. Rufaro. My educational background, I have a Bachelor of Science in Economics, MBA. I am PMP certified for my career, and then the DSL, Doctor of Strategic Leadership. And that allows me to really just dive into different industries and do what I call some of my passion projects. So this is part of it. Vend here, and the tax services that we're now offering with Vend here. We do other things that are more of strategic advisory, and so that's where my DSL really comes into play. But I'm also using it as a vehicle to give back to the community. So that's why I'm doing this, folks. And don't worry, we all have our P10s for certified tax preparers. We also have our EFIN, so we can e-file for folks. And as alluded by Ms. Candelata, we do have some resources with CPA and years of experience doing taxes. So that's a little bit about me there and my background experience. I like to say I don't like taxes. I love taxes, and I'll explain why. Because we really can use this. We really can use this as a vehicle to really move forward and achieve our financial goals. So that's a little bit about me. That's a picture of my husband, Kola, and my cute little son, Caleb. He motivates me so much. This is part of the reason why I'm doing this morning. You can tell I have a lot of energy. He was up early today, so we've been jiving. I like to call him Dr. Baby. So Dr. Baby is also part of the team. He's helping us achieve our goals here. So some of our goals, if you look to the far right of the screen, you see some bullet points that I've listed there. And this is really important because I'm trying to make this really practical. We all have goals. We all have different goals. And me and my husband may have a little bit what's called aggressive goals, but hey, to each his own, right? So one of my goals is to officially retire by the age of 40. And you're looking at me like, what? That's crazy. Well, the thing is, when you reframe your mind, the traditional kind of concept of retiring is 63, 67, the normal retirement ages that are out there legally, which is fine. However, we've kind of decided that we want to kind of redefine what early retirement looks like. And it's not in the traditional sense of, hey, retiring from my career, I got my 401k or TSP for those that work for the government. It's really to transition to a more flexible lifestyle with different earning capacities, different streams of income. So we have redefined what retirement looks like for us. And for me personally, it's just no more W-2s, no more 9 to 5. It's strictly doing 100% business and having, different investment vehicles that we are pursuing, one of which is real estate. And a lot of this presentation will be kind of tailored for that, for those that own property, that are blessed to own property. That is a tremendous way to save money through your taxes, is through real estate. So we've redefined what retirement looks for us. So that's one of our goals, is typically we want to be doing our own businesses by that age. And then when the traditional retirement age, it'll just be an additional stream of income. And so that's how we've refocused some of our financial goals. So I just wanted to caveat that so that you're not thinking, what in the world? How are you going to retire by 40, you know, or 50 for my husband? But one of our main goals starting last year was to pay off all non-mortgage debt. And by God's grace, we were actually able to do that. So as we speak right now, we only have mortgage debt. We don't have any car loans, any credit cards or anything. And that was a strategic strategy, that was very strategic for us because we recognize that if you get rid of a lot of those, it frees up a lot of income to continue to invest. And one of the key points of this presentation is the IRS rewards investor behavior. If there's anything that you remember from this presentation, you may not remember some of the other strategies or situations. I'm going to present 3 scenarios. You may not remember any of that, but please just remember that the IRS rewards investor behavior, meaning the more that you find different avenues to invest, and everybody has different risk tolerance. Some don't want to do a business, but they're okay with doing 100% passive investment vehicles, such as leveraging your 401k from your employer or investing in other avenues on a broker like a Fidelity. That's completely fine, and you could do that. And guess what? There's ways that even just doing that, you can lower your taxes, you can defer taxes, and you can save money now to increase your cash flow. So we'll talk about that. So if you can remember, the IRS rewards investor behavior. So one of the other goals is just, again, looking at what other behaviors does the IRS reward. Investing in a business. We talked about tax advantage accounts like 401ks. Owning a business is a massive way to lower your taxes because instead of your income being taxed first, you get to deduct a lot of different kind of business categories. And we'll talk about that in a little bit detail when we get into the scenario, because I want to show practical numbers. And I've made this very personable so that you can see that, oh, wow, I could do that. Yeah, I have that too. Oh, yeah, I could do, you know what? I should think about doing that too. So we can help with that when it goes into, the more detailed, finer detailed things. We'll talk about that later. But we're just out here just trying to share information to say things are changing, and for those that are considering approaching retirement or just planning towards it, it's never too early to plan for that, because the earlier you plan, the more time you have. And so the more time you have, you can look at the different investment vehicles or opportunities that really fit your lifestyle. You don't have to do real estate, you don't have to do a business, you don't have to just invest in tax advantage accounts. So we'll get into that. So these are just some of our goals. We have businesses that we're going to invest in our businesses, because the more we invest in that, business grows. And as we can strategically structure how we even do our business so that we can leverage a lot of these tax strategies. The other goal that we're looking to, and I just put it on here because it'll make sense as we go through the slides, is we're considering to invest in our real estate properties. We have primary resident and an investment property. And that also, there are ways that can be advantageous also to your tax planning and your overall financial goals. But I did put on there, the last one was invest in a multifamily. While the real estate industry is a little bit tricky right now, the key thing with real estate is you should always want to pursue an opportunity at the bottom line that you can afford, whether interest rates are high, low, whether purchase prices are high, low. All of that is relative. The bottom line is, so long as you can afford whatever payment, monthly payment, if you're taking a loan, if you're doing it as an investment property, there are ways you can leverage your business to actually fund more properties where it's not in your name, it's in your business name. So there are so many things you could do. And again, there are tax benefits to that. The IRS rewards all those kinds of behaviors. So we're going to get into that. So the next slide here, I always like to frame whatever I present with my 3 Bs. And I've even used this when we were talking about personal finance. Is 3 Bs is to be conscious, be systematic, and be proactive. So here we're talking about tax planning. And this is a simple way you could kind of reframe some of your financial goals, including tax strategies, which is to be conscious. What is my tax situation? Do I even have a situation? What are the different things that I have in my life that maybe I actually haven't realized that, oh, wow, I didn't realize that if I just kept the receipt for this or that, I can actually use that as a tax deduction. So being conscious is a critical aspect of doing anything that we're talking about right here. And so that could also look like, the next thing was how you're organizing your tax records. Are you using a tax professional? Because even if you're using a tax professional, you still want to have some form of record keeping. And if you have a business, that's where someone like Quinette comes into play, because she does bookkeeping, right? She can help you out with that. So that's what we're talking about. Is how you're keeping those records, because the more you do that throughout the year, and throughout the year, you're doing more of those investor behaviors that the IRS rewards, it makes everybody's life easier and you will benefit exponentially. And then the third thing is to just be proactive. This is something a lot of people, they think of taxes. Oh yeah, I'm gonna get my, okay, end of January, beginning of February, I got my W-2, I'm good to go, I'm gonna file my tax. But the truth of the matter is, if you're proactive throughout the whole year and you strategically plan, you know what, this year I'm gonna do this, I'm gonna do that, while it's gonna increase your income because it's an investment opportunity, the IRS rewards that behavior by giving you deductions or credits or whatever the case may be. And so you can actually use that savings, again, that delta, to aggressively attack whatever your financial goal is. For me and my family, is paying off debt and then being able to help family, because now we've freed up a bunch of cash flow. We can help friends, we can help relatives, and we can most importantly pay down that debt. Why is that such a critical thing for us? for us personally, because of our retirement goals, if we are planning to retire early in the form of, doing business, transitioning out of 9 to 5 and things of that, drastically reducing your debt lowers your overall cost of living. And that's what everybody's crying about right now is cost of living. So if we could do that, then we've now really opened up our options of, you know what, we could take a year and we could just, let's go to Africa, let's go to Nigeria, let's go to Zimbabwe. I'm all for it. We could do that because we have really set up our lifestyle to where our cost of living is dramatically low. So that's what we're getting into today. So again, tax planning strategies is you want to structure your finances to be able to reduce tax liabilities. Most importantly, stay compliant, and that's where we can help with that. There's so many tax efficient strategies out there. Some people may even, I was thinking about the other day, if you have like an emergency fund, most people might put that in a high yield savings account, which is great. Might earn 3% on it, 4% on it. But another way you could do that is to put your emergency fund, your maybe your long term, maybe like your 3 to 6 month savings, if that's part of your goals, is to put it in a municipal bond. Why? Because that will probably earn the same interest rate as a high yield savings account. However, that is not taxed, whereas a high yield saving account is. The government will not tax a municipal bond, but they will tax a high yield saving account, the interest that you earn. So those are just little things that it's just reframing how you think about, things that you're already doing. You're already saving, but maybe where you're saving it, you could switch the vehicle and it'll give you a different result. Now, other investments, yes, you got to pay taxes, right? Capital gains if you sell and all that stuff. But a municipal bond does not, the government does not charge any taxes on that. And then you have other things like HSA, house savings account. And those are all what we're referring to as tax advantage accounts. So invest in yourself. It's very important. Whichever way, whether it's education, whether it's investment vehicles, the key theme of this presentation is the IRS rewards investor behavior. So I'm going to show 3 different scenarios just to keep it, again, very relatable. These are common situations. There's a situation where someone may be doing their W-2. They work a 9 to 5 and they don't have time to start a business or side hustle business. I always recommend people, if you can do a business that's online, that's the best way because you can take advantage of so many things. So they don't have time for a business. They don't have time for real estate. So they are pursuing, hey, I'm going to do my job. I'm going to invest in as many tax advantage accounts that are available to me through my employer that put their contributions, but I'll also invest maybe in other vehicles online. And that it's 100% passive. It is not taking my time because I don't have that much time. So for that person, they will be able to defer taxes now to lower their taxable income. And then it allows them maybe to focus on their career and other things that they have going on because they just don't have the time. And guess what? They'll still be able to meet a lot of their goals that way. It just depends on your situation. Then there's another person who, hey, yeah, I have a W-2, but you know what? I think I could do a pretty good business on the side. And so they will start maybe an online business or a business that they do on the weekend. And that will open up a wealth of opportunities for tax deductions by doing that. So this person is more focused on increasing their income, right? They are willing to kind of split their time between their career and their business, but their goal is probably to increase their income. And when you increase your income more on the business side, you are able to save more money. And I'll show a scenario. I have the Excel where when you own a business, you can take advantage of like a home office deduction. You can take advantage of so many different expenses, even your cell phone bill, your utilities, because if you're working that business in your home and you dedicate a space, you cannot take 100% deduction. Like if your cell phone bill is $100 a month, $1,200 for the year, you can't deduct the full $1,200, but you can deduct a portion of the percentage that you use for business. So if you say, I use my cell phone 30% of the time for my business, then you can deduct 30% of your total cell phone bill. Does that make sense? Does anyone have any questions about that? And I'll show the actual numbers about this because I'm all about showing the numbers. Like, it's like, okay, I hear what you're saying, but show me what you're talking about. So, but does anybody have any questions on that? Good, good. All right, let's keep it moving. So the third scenario is, hey, maybe I'm working my 9 to 5, but I also own real estate. And this is a great thing if it's your primary resident, but more specifically, if you happen to have an investment property. And again, like I said, everybody's situation is different when it comes to real estate. If you're pursuing real estate, I know the interest rates are high, but that may not be the only thing you look at or that may motivate you to pursue real estate. The key thing with real estate, I always try to caution people, is make sure whatever you're pursuing, whether the interest rate's high, low, purchase price is high, low, you can afford the payment on the mortgage. And so I'll just share a very key example that me and my husband are looking at is leveraging our businesses to pursue maybe like a new investment property. So we have one, we're using those deductions. It's phenomenal, and it's really opened our eyes to be like, wow, this is amazing because you can really do a lot. So those are the three scenarios that I just want to show folks that, hey, this thing is really possible. So we talked about scenario number one, tax advantage accounts, your 401k, HSAs out there. Those all help to defer your income now. So very quick example, at my job this year, I was like, oh, I want to increase the amount that I contribute. I moved it from 6% to 7%. I eventually, hopefully, if I get to 10%, that'd be great. But just moving 1%, it saved me an additional like 5,000 of taxes that I would have paid. I no longer have to, just changing 1% of my contribution. So very, very effective. Again, doesn't involve you buying real estate or anything like that, but it's really important to try and leverage what's already available to you. It goes a long way. So the second scenario again is owning a small business, and you can have so many business deductions. We talked about deducting your cell phone bill if you use your car for business, a Porsche. Again, you want to understand how much personal things you're using for your business. It has to be dedicated for business use. The home office, and you take the square footage. So for example, say you have a house is 2,000 square feet and the office space you use is 200 square feet. So that's 10%, right? So in that case, imagine there's some bills that are related to your home that you can actually deduct um, through your business. It has to be for business purposes, but you can only deduct 10% of that. And I'm going to quickly show an example of one of those actually uh, home office per se. So just bear with me. I'm going to pull this out and see if I can share the spreadsheet. Let me know. Can you all see my spreadsheet I just put on the screen? Awesome. Awesome. Great, great, great. And this is really important because some people get carried away like, oh, great. Can I deduct my mortgage payment? I'm like, slow down, slow down. This is very important to really break this down and kind of show a practical example of what we're referring to. So this is for a home office. And let's say your total payments for your house, this was including mortgage interest, home insurance, all sorts of stuff, right? Let's just say for the year it was 19,000. But at the end of the day, what I can deduct from my home office is actually 6,500 or 587. And how did I come up with this? So I made just a simple example, is like from last year, January through sorry, I think this was supposed to be December here. It's missing a one. It's got a list of expenses, and these all expenses relate to Schedule C on the 1040. And you don't have to really know all that. That's where we help you with that. But this is just an example to show that you can have certain direct expenses, Wi-Fi, utilities, maybe some cleaning. You hired a cleaning company, whatever the case may be. So long as it's allowable on that Schedule C. This was the actual cost. This column right here, this was the actual cost of all those things, rounding up to 19,000. However, you take a percentage of it, and that becomes the total amount that you can deduct. So these are things you're already paying for. It's a matter of just tracking them and actually being aware of like, oh, I paid this person to for snow removal or HOA or whatever it was or gas. You could there's a lot you can, and this is just like primary residence. Again, if you have a business, you cannot do this if you just have a real estate property and you're saying, well, I have a investment property somewhere else and I'm private resident, so I'm going to deduct home office expenses. It has to be for an actual business because the IRS considers real estate, it treats it as a business, but unless you're actually incorporated for real estate, you don't want to do that. So, but if you have other businesses that you do, online business, that you work from home or things of that nature, this is where this is applicable. So this is for scenario two, a person who's working, but they're also doing a side business and they're like, oh, you know what? Yeah, I pay utility bills, I pay, the electricity, the gas, whatever is attributable to home office, you can actually take a percentage of that. And in this situation, I believe it was about 30% of the house was dedicated to a home office space. And so they were able to deduct about 30%. Here it says 29.7. I'm just rounding up 30% of the expenses. So does that make sense before I move forward? Yeah, like you cannot deduct the full 19,000. That's not what we're saying here. But that's quite a lot of money that again you're already paying, but you're actually saving because now in addition to like that 5,000 that I mentioned, just by increasing 1% of my 401k, that was 5,000. Now I just added an additional 6,000, 6,587. But again, these are all things that you are all available to you. It's just how you're seeing it and how to reframe your mind. So Candace, you have a question?
I do. I have two questions.
Mm-hmm.
The first question goes back to your 401k increase. And I
Mm-hmm.
would like to volunteer another scenario.
Okay.
Um, Say you have a person that is not contributing to their 401k at
Mm-hmm.
all, right? How do they get to figure out, because it's a bit of a math equation, how much is being taken away from them because they're not contributing and
Mm-hmm.
what they would be, I guess, saving if they were contributing. So,
Right. Kind of do like a comparison. You want to see
yeah,
what's more
like,
advantageous.
yeah,
If
like
I'm not
how can,
contributing, if when
mhm,
you're whenever you're not contributing, obviously you are getting that net income in your in your salary, right? In your
mhm,
biweekly paycheck.
yeah,
Um and so but the thing is when you're getting that net, it's been taxed first
yeah.
and then you're getting the net. But
Mhm.
when you're investing or contributing, that portion that would have been taxed is not being taxed. It's going into your 401k and it's growing, right? Through investments, it's growing and you're not paying taxes on that. Now, the idea is when you come to the age of retirement, when you get ready to retire and you start taking withdrawals, right? Distributions, that's when you're taxed. So what happens is if you're contributing to your 401k now, you are able to lower your taxable income. So that what I explained is, oh, I based on some of my income, I would have been taxed, for example, 25,000 for the year. I would have been paying that taxes, right?
Mhm.
But now I'm only going to pay 20,000, so it's 5,000 savings, right? And so that savings has gone into 401k and it's now growing, interest in all of that stuff. When you retire, you will pay taxes on it, but normally when people retire, they're in a lower tax bracket. So let's say
I
you're
was
in a
gonna say, like,
25% tax bracket or 30%. When you retire, you may be in a ideally you may have structured yourself that your odds are you're in a lower tax bracket. So when you do withdraw it, maybe the 4% rule is going to be maybe at 15% or whatever your tax bracket is at that point.
so do they have a calculator or a resource where the normal person can see,
Yeah.
like this is what's happening to me because I'm not investing. This is what will happen if I did 1%,
Mm-hmm.
2%, or 3%. Kind of seeing it in that way. Like I'm not a math girl,
Mm-hmm.
but I do notice because I just switched over the umbrellas of the companies that I'm
Mm-hmm.
in. And the company that I was in something that my employer said to me, he said, well, you've been doing a great job, so I'm giving you a 5% increase. We like that.
Hmm.
But then they also said, and also, you could contribute a little more. That'll give you about a 8% bump. Like he knew to the to the percentage
Yeah, there is a way
how
to
much more I
calculate
would
that.
make a year. And I didn't quite understand it, but I still followed his advice and I invested more and he gave me more. And ultimately, I made more everywhere. Like my investments went up, they were going
Hmm.
up so quickly. Like it
Right.
was like a few thousand and a few more thousand and a bunch of thousands. And I don't think on my best day, I would have saved $19,000 in a year or two.
Hmm.
So I mean, I subscribed to the system, but I surely didn't know how to really
Right, right. I could
calculate what I
definitely
was
send
doing.
you a resource. And maybe I know there's another app that I use the way you can kind of see that calculation. Sometimes your employer actually has that calculation for you. It's
Mm-hmm.
sometimes in a employer portal. If your company uses, for example, ADP, that calculation is actually there when you're signing up where you want to make changes. And you'll like put the percentage, you say, you know what, I want to put 8% or whatever. It'll automatically show you, oh, if you put 8%, this is how much you're going to get in your net,
Mm.
in your biweekly check. So that could be a good resource is to, if you log into your employer portal, wherever you're allowed to, because you can make adjustments anytime throughout the year. You that could be the number one resource. Other than that, after the call, I can definitely send you like the calculator thing that I use. But you can see that. Yep, there's a way to calculate that. And it depends on everyone's situations because some may increase and say, you know what? Right now I really need the cash flow. So even though it's tax, I still would like more cash flow. So I can only go up to maybe 7% or 8% or whatever it is, based on how much you earn.
And
So
for
there's
me
ways to look at
personally,
that
that's been
and
a tough call to me. This is the
mhm.
first time since I have the new employer, they give you a window for when you can decide that you want to contribute. I believe the
Right.
window is coming up in April. So for
Hmm.
these first few months, I've just been just taking it all. I'm not
Hmm.
sending anything anywhere. And a piece of my mind was wondering, like, is this to my advantage? I think having the most money I can in hand right now is pretty important because
Yeah, it's totally dependent on your situation because some people may be in a situation where you're like, you know what, for the next 6 months, I really need the cash flow because I need to do this, I need to do that, I need to do that. And that's okay. And then later on you can adjust it and say, you know what, okay, I'm good. I accomplished what I need to do. Let me go back and increase X, Y, and Z. Like for example, for us, for me, I've stopped at 7%. For my husband, he's planning to try and do 15%, which is really aggressive, but it's okay because our combined income, we still have everything we need to do what we need to do.
you can go up to 15. I thought the max was 10.
No, you can go up to 15.
Mm,
Yeah.
okay.
And it also depends on how much you earn because there's limitations on like caps. I think it's like what is it, 23,000 or something for the year. There's limitations that the IRS puts. But
Mhm.
yeah, you can go up. Yeah. So we'll keep it moving. But yeah, this was just an example of the home office because this one sometimes people get in trouble with that because they start deducting it. Oh yeah, I have a W. I work 9 to 5. I work from home, so I can deduct. No, you can't. It's for business purpose only.
I have
Is
a
you can use that.
question.
Yeah, go ahead.
So with regards to the expense that you're just showing us now,
Hmm.
what can you explain in just a little detail? If you have a business now and it's not generating as much income, or you didn't contribute the income to your business, and
Hmm.
you do plan on deducting a certain percentage, how serious or how much do we need to keep in consideration of what we're deducting when we know we didn't have the income?
That's fine. The IRS is not everybody has net profit. Some years, some businesses don't have a profit. Some people businesses have a loss. The IRS is not really concerned with that. They're more so concerned with, okay, I'm just using example numbers. A business made 50,000 this year, and but the expenses exceeded it by 60,000. If you have the records and you're showing that this is the situation, So long, that's the key, records, right? Records, records, records. So it goes back to the bookkeeping from the business aspect. If you're showing that, there's nothing wrong with that. You are just reporting that you had a loss for the year. And that means you're not paying any taxes when you have a complete loss.
Perfect. Thank you.
Just one more with the home office and the work from home, because those are two different things.
Two different
But I
things. Yeah.
happen to do both of those things. I work from home and I have a business, and I would like to be able to do both, but is that considered double dipping? So like if my work from home deductions, would they consider that overlapping because I'm one entity doing these things from the same place?
No, no. The only key thing is to make sure you're dedicating the space for business. So if you use that space partially for your W-2, but that it goes back to this appropriation, right?
Mhm.
Of like, okay, how much is being used for business use? That's the key thing.
Right.
If you can determine that, it's fine because where you're reporting your expenses for your you have primary residence, you're going to be having mortgage interest and all that. That's a different place than where we'll be reporting the home office under your business. That's under Schedule C.
Okay.
Where you would be reporting the other expenses for your mortgage interest and all that stuff, that's different. That's on your personal side. It's all on your 1040, but Schedule C is attached to your 1040. So the IRS knows if you're putting it on Schedule C, they know that, oh, this is for your business. And hence why it goes back to the percentage, and you have to keep your records so that should ever, you get audited or something like that, your mind is clear because you're like, no, I have my records and everything is good to go. So the important thing is what is being used for business use, and they break that down by percentage, and then you keep your accurate records of the percentage being used for business use. So it's not double dipping because this would be under Schedule C. It's being reported somewhere different from your regular personal expenses that you're using to deduct. And that's if you're deciding to itemize on your personal side. Because you can decide, oh, it's not worth it. Let me take a standard deduction on my personal. And that might be more depending on your situation.
Okay.
Yeah.
With the standard deduction, do you have to just make sure that your receipts at least make the minimum of the standard? So if the standard deduction's $2,000, you need to have like 2,000.
No, the standard deduction is based on your filing status. So if you are, for example, for me, I'm filing married filing jointly. So the standard deduction for that is much higher than, like, let's say a single person, but it's also different if you could probably file as head of household, right? And you have dependents and different things. So the standard deduction is based on your filing status, and it's already set by the IRS. You don't have to like figure out like how much standard deduction do I get? Like it's set yearly. Most of the times every year it increases just a little bit. I believe for singles it's like 12,500. For head of households it's a different amount. For married filing jointly it's different. And then the status that is least advantageous is married filing separately. Yeah, that one, really messes up some folks sometimes. But yeah, so that's how standard deduction is. So what typically happens is if you've kept all your personal receipts and all of that, if your expenses itemized is different than standard. If your itemized expenses exceed the standard deduction, then we as your tax, professionals will say, oh, it's more advantageous for you to take the itemized deduction. But if your standard deduction is exceeding your itemized expenses, then we would say, no, it's more advantageous for you in this situation to take the standard deduction. So don't need to worry about that. I could go into that in detail with you offline, and that's what we help with. We look at that, but we also look at, proactively tax planning. What are the strategies you can do to say, okay, in 2025, I could do this, I could do that, I could do that. And all of these things are going to save me money on my taxes legally. That's why I love taxes. I think you're on mute.
I was going to say, so your outlook isn't just for how we can be prepared for our taxes for 2024 that's already passed and gone,
Mhm.
but also now with this knowledge, behaviors
Mhm.
that we can change to have a better
Absolutely.
upcoming tax year.
Yep, that's
Okay.
where the money's at.
Okay.
Yep, that's where it's at. Because the more you do that, you'll be surprised, like, oh my gosh, like this is amazing. And again, we'll get into real estate, which is the next scenario here. So I'm going to put this down. So this was just an example to show that all of these, everything in this column here was the actual expenses for someone who's looking to, this would be on their Schedule C related to their business use. Again, you're not able to deduct all full 19,000, but what you can do is take a percentage of what's being used for your business use. So that's the main thing I was just trying to show there. You don't need to get into the math or anything like that. So that's and again with business, the other thing you can do that I always tell people, if you and when you get to that level, let's say your business is earning consistent income. Don't do this when you're first starting out. Please don't do this and say, Rufaro told me. Please do this. Let's say your business is earning consistent income at a certain level. You can decide to, instead of purchasing, let's say you need a new car and you know you use a car partly for your business. Instead of, you can decide to purchase a car under your business. You can also decide to lease a car under your business. The only reason why sometimes I kind of favor purchasing a car, you're able to take depreciation as well and other costs of maintenance of the car, but it's all under your business. Of course, the business needs to be making income enough to cover the expenses, right? But what I'm trying to say is those expenses are deductible. Whereas when you're doing it with your personal, you're not getting anything extra except for paying down your loan, right? And it's the same aspect with leasing a car. The only reason why I kind of like leasing a car, when you lease a car, you cannot take depreciation, and I'll explain depreciation. It applies to businesses and particularly real estate. We're going to go into that in just a few minutes. I don't want to take people, I'm going to wrap this up so that I can allow people to ask questions, and feel free to ask questions throughout. But I do like the idea of, and it's something that we're looking to do in the future, is leverage our businesses when they're at a certain income level. And whenever we need a car and we know we use the car partially for business, again, the same thing like we did with the home office, part of the expenses can be deducted. You can, but if you're using the car completely just for business, then you can take 100% deduction. Let's say the lease payments can be 100% deducted if that car is specifically just for business. Like this happens with people who do. Let's say my husband, he has kind of like a HVAC small business. In the future, he plans to buy a truck, that he's going to be using to do work orders or for other people that will help him. That car, if he purchases the expenses for that, that's completely for the business. That can be deductible. Yes, 100%. The lease payments can be deducted if he decides to lease the car instead of buying the car as well. Why I like lease is because, well, sometimes, with small business, that, okay, my business has been doing very good for a couple of years. I know I can sustain this. But let's say maybe you decide to ramp up or shift something in the business. You're not stuck with the loan. You know what I mean? You have the lease for 2 years or 3 years or whatever your agreement was. And then some of the maintenance is a little bit less too as well. So it just kind of depends on your situation and use. Some people, it may be more advantageous to purchase, and that's fine. The main thing here is knowing what percentage is being used for business to be able to deduct those expenses. So I do like that strategy. It's pretty good strategy. And then owning rental income properties while you work. And to me, this is probably the situation that allows for the most deductions. And again, you can do any combination of these. You could work at 9 to 5, have a little, even if you have your primary residence and you decide to rent one room, guess what? You're in business. You can take some of these deductions that we're going to talk about for real estate. So you don't necessarily have to go out and like, oh, I'm going to go purchase a whole property just so for the deductions. No, this is an added benefit of your investment, but you need to be able to afford the investment, right? So yeah, we'll get into that. And again, if it's a business, if you are actually incorporated, because there are some people who are in it for the long haul, and I do recommend that, I do always recommend real estate more as a long-term investment. And depreciation is probably the king of all deductions. But depreciation works even better if your strategy is to buy and hold. So we're not talking about fix and flips. We're not talking about wholesale, none of that stuff. This is just buy and hold with the plan of I'm going to pass this asset on to my children or a relative or something like that. That is the most advantageous because I will explain depreciation and how it works with real estate, and it's really just beautiful. I don't know how else to say it. I don't know how else to say it. So I want to differentiate. There's a difference between having being a real estate owner. That's just, hey, I have my primary residence, and I'm gonna house hack and like rent one room out. At that point, you're a real estate owner. Real estate investor is when you have your primary residence, maybe you're house hacking there, but you have another, at least one other property somewhere that you're not living in. It's not your primary residence. That's when you're now real estate investor, and now you're afforded even more deductions. And now the best status is when you're a what they consider a real estate professional, meaning you have multiple properties. You are materially participating in managing your properties. You spend more than 750 hours throughout the year doing it. And you can also be involved in other things such as a real estate agent or broker. But the main thing is you own more than one or more investment properties. Again, these are the ones you don't live in, right? And why is that status so important? Because what differentiates that real estate professional status, this one right here, sorry, there was supposed to be a picture here, but it was just a step picture, is the fact that if you're still a W-2 and you also are a real estate professional status, the IRS allows you all the deductions you're benefiting from real estate, you can deduct that against your W-2 income, which is a game changer. Like, think about what you can do with that. But so it's a little bit harder to obtain the status, and it's for a reason because not a lot of people meet the 750 hours. So you have to keep really good records. So that's one way. Another way you can get that real estate professional status is through short-term rentals. So if you're doing Airbnb, but again, this is for the long haul, you're keeping the asset for the long haul. You can get around the 750 hours if you're doing short-term rentals. I think the hours then reduced to like 100 instead, or 100 or 200 instead of 750. And then the other way is real property trade. So again, if you're like a real estate agent on the side or things of that nature, that also qualifies you. The IRS has about, I think, 8 different types of real estate trades that qualify. Is it possible to obtain real estate professional status with just one investment property? It is. If you really are like materially participating in it, meaning you're not really, and you do this by like not hiring a property manager. That's another way to kind of do that, to show that you've been putting in the hours. Another way is you may have only one property, but again, back to the goal that I had on the very first page of multifamily, we are not claiming that status now, but if we do get one other property, that would be more than enough to suffice for that status, which is a huge game changer because what it means is you use what's called Schedule E. I'm gonna go to the next slide here. You use what's called 1040 Schedule E. So when we were talking about the small business, we're on Schedule C, where you do all those deductions. So there could be a scenario where I have a W-2, I have a small business, Schedule C, that's being reported separately. Then I have Schedule E for my real estate, where a whole laundry list of other deductions are being deducted. Similar to the business, but this is specific to real estate. So this is where people can really use the tax savings to really meet their goals. And I've experienced it even just from 2023. I can show you the comparison in just a minute of how much I was able to deduct. And it really does make a difference because you could be in a situation where you're paying like very little or very close to zero income on zero taxes on your rental income, on your real estate rental income, which you're like, what? Well, I'm not gonna lie, that's how some people do it. You know, I'm just gonna throw a name out there. We all know people say, oh, Donald Trump, did he should pay taxes? I'm not gonna lie, he does this. And some other people does it. And I'm not saying, you know, we're trying to copy him, but I'm just saying there's no reason why not to take advantage of this if you currently own real estate, you know. Um, and you could start with, hey, I don't have an investment property, but I own a primary resident and I have an extra room. That could get you started right there just to tap into some of these deductions, which is amazing.
I
Now,
have a
again,
question.
mhm,
This question is more about like family legacy properties.
mhm,
Like, we are getting older, we're losing people, and they're leaving houses, And so in my situation, that's two homes, but one of the homes I like partially invest in. I don't
mhm,
do the whole laborious day-to-day things. My dad does those things,
mhm,
but I've invested through loans into that property. That's it. He does like the insurance part and like the other
mhm.
components. Can only one person take deductions on a property, or do they have to be mindful of which deductions? Like I can do my deductions and he can do his deductions, but they can't
Right.
overlap. Like, how does that work?
That is a great question. That question is dependent on, it boils down, unfortunately, to ownership. So you could be, like, for example, I could be helping, let's say my parents pay their mortgage, but only they can claim the mortgage interest because their names are on the deed. So it goes back to ownership.
We're
Now, if
both
your name
owners.
is on there,
Mhm.
if your name is on there and you receive, I believe it's called the 1098 from the mortgage company, yes, you can do it.
Well,
So
it's
that's
paid
the key.
off. It's paid off because it's so old. It's paid.
It's paid off, then there's no mortgage interest to deduct.
Mm.
Yeah, there's no mortgage interest. But if you are uh if it's paid off
Hmm.
and you are renting part of the house,
Hmm.
those expenses can be deducted if your name is still on the ownership. Does that make sense?
It is. I guess what with it, this is our first scenario being compensated for that property in this way. A
Mm-hmm.
piece of me feels like this is too complicated. I like just forget
Mm-hmm.
about it. Like don't even mention it. I got my money. I'm happy. Just
Right.
mind my business. But with my bookkeeping sisters and my accountant on the line, that's probably not the most responsible thing to do, but I just don't know what to do with it because it's like it's a partial, like I'm a partial owner and
And
I
sorry, did
partially
you say your name is on the deed
mm-hmm. With
for
my
the family one?
with my dad.
Your name and your dad.
Yeah. Who's on the call? Hi
Oh,
dad.
okay. Let's take that one offline since it's getting a little bit more personal situation. We'll take that one offline. Sorry, I'm trying to fix this light so that it's not blurring my
Okay.
eye. But we'll take that one offline so
That's
that we
advanced.
can, yeah, yeah, because that's a little bit, that's a very unique situation. It does boil down to ownership. You can always, if you all both own and things of that nature, and there's expenses related to rental income, it has, in that case, you all are like operating like a partnership.
Mm.
You may not have the paperwork, but that's what you all need to actually put in paper. You need to get that documented so it's more than just the deed,
Mm.
because the paperwork, which would be like almost like a, if it was any other business, would be like a Schedule K1, a partnership, and that partnership would dictate who owns what percentage, and things of that nature, and how that flows down to you, especially if you have what's called an S corp LLC. But again, let's take that offline, and then
Okay.
we can
We'll
address
keep
that.
that as our advanced 2.0. Once we figure that out,
Yeah.
we'll package it up and that'll we'll show you guys what happened later.
Right.
Thank
So Schedule E is phenomenal. Again, after this call, I want to get close to wrapping up. I can share, if you email taxes at Vend here, I can share some of the resources that were on this presentation. And then if you also want to just go ahead and say, hey, I'm interested, how can you help me out this year? Just email taxes@vind here and we'll start the onboarding process that way and get you set up. We have like a tax checklist. You can just check that, and if we need to do like a 15-minute call to assess your situation, because everybody's situation is different, But again, this presentation is really focused on investor behavior. The IRS rewards that, and it's particularly if you got anything to do with real estate, whether it's your primary residence, additional investment properties. I mean, that's the way to go, So, and I particularly use Turbo Tenant. I could send you a link to what I use to manage things pertaining to real estate to make your life a lot easier. I keep the app on my phone, and that's how we manage our tenant and all of that stuff. It's all automated, makes our life a lot easier, and we can deduct expenses. It helps us track the expenses. So a little bit of show and tell here. I am going to actually pull this over here so I can quickly show you. This is just a practical quick example right here. Sorry, excuse me. As this loads, this is what I was talking about. Come on, load. Make sure this one's loading too. Okay, great. I mentioned Turbo Tenant. So this is a tool that I use, just sharing, and I can send you a link because it's really been phenomenal, from advertising properties and all that stuff. And then most importantly, I'm just showing you the expense portion of the categories that I was talking about on Schedule E. And this one is great because it's already organized it for you. You don't have to like think about anything. And then you just, all right, cool. This is related to maintenance. This is related to whatever. And then you upload the receipts, all of that. It's all there. I don't know why this one is taking so long to load. This one's already loaded. All right. Oh, we'll go back to 2020. This was a 2023 tab. This is 2024. I'm being very transparent here. So I was talking about depreciation. In depreciation alone, I'm able to deduct like $11,508. This is real expenses. And the beautiful thing about depreciation, why I want to emphasize that so much, is depreciation is a paper loss on paper that the IRS allows you to take. In fact, I actually read somewhere that it said it's illegal not to take depreciation. I said, what? Because if you ever go and sell the property, there's something called recapture taxes where they will say, oh, you should have taken depreciation this year, this year, this year, this year. You didn't. So now we're going to include it in your capital gains tax bill. And they call that, it's a separate line item, recapture taxes. So what depreciation is you have your property, right? You got a 3-bedroom, whatever. And on that property, it's going to depreciate every year because it's being used, right? Sorry. From the time that you purchased it. In the very first year, there's some other expenses you're allowed to include, like your closing costs and things of that nature, that go into what's called the cost basis of your property. So, for example, if you buy, I'm going to use very simple numbers, $100,000 property. Your total purchase price is $100,000, but your cost basis for depreciation purposes is not $100,000. It may be $75,000 because the land costs $25,000, right? So when we talk about depreciation, it starts with your cost basis, not your purchase price. And the cost basis is everything, the cost of what you purchased that property minus the land. So the land is not included because land appreciates. So we're getting a little bit into the finance here, but we'll keep it as simple. Land appreciates. So the land cost is not included. You buy $100,000 property. The cost basis is $75,000. And it was, let's say, a 30-year mortgage. But depreciation for residential purposes allows you to deduct, I believe it's 27 years and a half or 29 years and a half. So you divide that $75,000 by the 27 years that are allotted by the IRS, or the 29 years and a half that are allotted by the IRS. And that becomes what's called straight line depreciation. That number is a blanket number that you're allowed to depreciate, take a depreciation paper loss It's a paper that you're just creating. It's not an actual loss that you have, right? But you can take that every year. And if you're not taking depreciation, you are losing out on a lot of tax savings. So just in depreciation alone here, I have it broken down with 2023 versus 2024 depreciation costs. And I'm gonna make this bigger to make sure people can see this. In 2023, my depreciation was about 3,139. And that's because I only started renting halfway throughout the year. I think I started like it was March or June in 2023. So from that to December, that's how that calculation was incorporated. But for 2024, it's the full 12 months I rented it out. It rented out this particular property. And so the beautiful thing, I also looked, the IRS allows you to say, oh, you didn't take it in this year. If it's still, your first full year or whatnot, you can still go back and take that. So for this first year, I'll be able to deduct a total of 11,508 in just depreciation. This is a paper loss. It's not an actual realized loss compared to the income I earned on that property, which is great because it's lowering my taxable income. And for all transparency, I earned 30,000 from this rental property. So I'm already able to deduct that amount. And I didn't do anything. That wasn't even like, you know what I mean? I have actual other expenses. Like for here, the second one, you can see mortgage interest paid to the bank. And it's very easy. And I always put the Excel, I always put the document, I attach it right there. So you got to keep really good records. So for here, mortgage interest, this one was simple. I got my form 1098 from the mortgage company. I attach it, simple. It tells me I have 7,500 whatever in interest. So I just put the number there, attach it. And I always put December 31st because instead of putting an entry for each month, this is just how I do it to simplify. The document it's got everything broken down each month and the total, and then I just put the entry in Turbo Tenant. So that's how I do it. If you want to put each month, that's up to you. But I just put the total because the 1098 is what I'm showing is like, this is my document to back up what I'm saying. So that's a key part. That's how we do this legally. Okay, we're not doing tax evasion. We're legally deducting. So just in mortgage interest alone, that's another 7,500. And then in taxes, which is also on my 1098. So I attach the same document. That's additional 3,550. Insurance is also on 1098. So 1098 has a lot of deductions right off the back that you can deduct for your primary resident and also your investment property. So this particular one is an investment property. So that's what I have there. It's all adding up. And then on utilities, I paid partial utilities for a tenant. I got a new tenant. The most recent tenant is paying the utilities, so I cannot deduct that portion, but I can deduct the amount that I paid for the utilities when I was paying it. And I have those documents. So that's the beautiful thing. I just attach it. Oh, here's Dominion's thing when this tenant moved out. And so everything is documented. And I even have a note, oh, paid under Pena tenant, only to remind myself. And so this is the beauty of real estate, folks. You can do that. Repairs. I had a miscellaneous repair I had to do. So I have the receipts for that, the invoice, from my technician. And so I just attached that. So long story short, repairs is part of it. What else can you do? Other HOA fees are allowed to be deducted. So I just put my receipts for that, for the history and the fees. Auto and travel, you're allowed to deduct certain part of auto and travel. And again, you have to pick either mileage or gas. For me, I pick gas because I don't travel that much to the property. So the time that the travel costs you spend going to your property can be deducted if you keep the receipt. Okay, so and that's if you're doing receipts like gas receipts. That's what I choose to do rather than mileage because I'm not driving that frequently. Now, if I was doing it more frequently, I would probably pick the mileage. But for this property, I maintain, and that's how I've done it, is like I just keep the receipt because it's like a one-off here and there. I don't go too often, but I do try to check. We personally try to say, okay, this year we've said we're going to proactively do some proactive maintenance, to check up on a property at least once every 3 months so that we can prevent certain things, with maintenance that will help, with repairs. So I had a few repairs. Something about the bathroom. I don't know, unclog the bathroom or whatever it was. Again, technician gave me the receipt. I uploaded it. Good to go.
So
But mhm.
calculated that you're gone past $33,000.
Yeah,
So what happens? Do you not pay any taxes on this income?
I'm not paying taxes on this property.
So I
Okay.
have a
See
question.
my smile? But it is the I will say the deductions, the IRS says if it's because they consider this passive income. I'm not yet in the real estate professional status where it's completely active. When I'm still in the passive income and losses category, back to this slide over here where we had the division. So I'm still technically, well, I have an investor property, but I don't have the real estate pro status.
Yeah.
So the IRS says you can deduct up to $25,000. So here what happens is there's something called carryover loss, which I'm documenting.
Mhm.
So for this year, I've total right now is like 33,000. The delta of that I've annotated as my passive carryover loss. And the beautiful thing is you can keep carrying over indefinitely. The IRS doesn't have a limit of how many years. So I'm keeping that because there may be a year where something else comes up and I can use that. This spreadsheet right here is my depreciation spreadsheet. This is how that calculation came up for the 11,000. First year, the property was in use for half the year, so the depreciation is about 3,139. But every year after that, because I'm using the straight line method, is 8,369. So I am allowed to claim the 20 tax year 2023 depreciation, and that's about 11,508. That's how that number came up. Okay. So I right now I'm capped at 25,000, right? But I can if I record my Passover losses, that 8,000 delta is what adds up to 33,000. So I'm still going to record. I'm still going to record. And then in next year it won't be as high as 33 because I won't have 2 years worth of depreciation that have been taken. And you have to keep track of this. Hence why we have people like myself, tax preparation and advisors that can help with this because you don't want to do this. If you don't know what you're doing, don't do it. Don't touch don't do it. Because in addition to depreciation,
Don't do it.
there's something else called cost segregation. You do a cost segregation analysis on an investment property. It means if you, and let's say the first year you bought it and you improve the carpet, you improve the cabinets, guess what? You could take depreciation on that. And the IRS doesn't allow you the 27 years or whatever, but they give you 5 years. They have categories. They say, oh, that one you could take depreciation for 5 years. Long story short, this is how some are paying very little taxes because they have the receipts, not because they're doing tax evasion. So I want to emphasize that. So every year, this is a straight line depreciation method. It's gone out to the 29 years allotted by the IRS up until the last day of my mortgage or whatever. And so it's already broken down. Every year I can take $8,369 in depreciation costs, which is a paper loss. It's not an actual loss. My actual losses stem from these expenses. And this tab here is my 2023 expenses. So I was able to deduct 19,871. And there is no depreciation on this list. This was just expenses that the IRS allows me to deduct against my rental income. I believe that year it was like 21,000. It was actually 20,000, but 1,000 was the deposit. So the IRS does not count deposit money because that gets returned. But my point is that year it was like I think less than $1,000 of taxable income on that property.
So I do have a question. I
Mhm.
actually got a little bit, I don't know, I just got afraid. I was doing, I think it's called Keynote. It's a different service than yours, but it's similar
Mhm.
in terms of like it takes the payments and it records the payments. And I was like, oh no, I don't know if I want them recording my income. And then the renter was like, they charge me $50 on this software to pay
Mm.
the rent. Is there a way I can, not pay $50?
Yeah,
So
no, that's a lot. Let me help you with that offline with Turbo Tenant because I don't charge my tenants anything. The only thing it charged is when I was because Turbo Tenant is great because it can also screen applicants when
mhm.
I'm advertising the property. It'll put a list, create a listing page, website. It'll push the listing to like Redfin, Zillow, and all that. And then when I was getting people interested in the property, so this all helps because I'm recording the time. This is all active participation, so I can use that, right?
I was using
Um, it
Furnish
was the only thing
Finder.
it charged my it was at that point it was a lead.
Mhm.
So to screen the tenant when the tenant did the form and then said, yeah, I want to submit my application. Part of my application included a background check, and that's the only thing that it charged the person who was willing to submit an application. So they had to pay their background fee. But apart from that, when they're paying rent, they are not, so long as they do the ACH bank automatic, they don't have to pay. The only thing it charges is if they want to use a credit card, it has a credit card processing fee and they pay for that. But the beautiful thing is for you, the landlord, the owner, I pay a premium subscription annually. It's like $100, which is totally worth it because guess what? I can also deduct that because it's part
Yeah.
of my
Oh my
software. Where do
God.
I have it? Yeah,
I'm
I do.
under Furnish Finder,
Here
which
it is. Turbo
um,
Tenant premium account, $100.
I'm under a Furnish Finder, who I've been using to find medical professionals because I was targeting nurses because I'm close
I
to
think I have heard of
hospitals,
that one.
and
Yeah.
they had their own hubs. So I guess that's how the businesses get going because they tied everything in.
They
Need
tied it to the medical, yup.
have a
Travel
yeah,
nurses and yeah.
and they said need help, we help you create a lease. And I guess whoever they've referred me to do this, what Turbo Tenant does, it's the tenant telling me how much it costs because on my end
You didn't even see that.
they
Yeah.
market how much it's no cost to you, but it's a
Hmm.
cost to somebody. So I'm
Yeah.
going to go in today and see if what I'm paying for has these features that you have, if
Yeah.
I can.
Mine has a lot. I'll send you a link. In fact, I'll drop the link in the I can drop the link. Where did I put it?
Because
Let
my
me grab
major
it real
question
quick.
is I like their hub for finding the tenants because those are the tenants I'm targeting, but
Right.
perhaps I can use them to find my target, but use this to maintain my records. I'm just not sure. I don't want to double pay my membership.
Right.
I just want to
Yeah.
pay
I
one
mean,
price.
the thing is, you're not restricted to medical professionals
Mhm.
being your tenants. So that's kind of the caveat. Now, if you're purposely that specific property, you
Mhm.
only want medical professionals there, then again, we'll take this conversation offline, but
Yeah.
then that's when maybe you want to stick with that. But if you're not restricting yourself to medical professionals, because guess what? Turbo Tenant is going to it pushes to many different platforms that are common for people. Zillow, Redfin, apartments.com. You can find my old listings on there because it pushed it there. So I'm getting all kinds of people based on the location. And if that location is close to a hospital anyway, odds are you're still going to get,
Yeah.
a medical professional.
Oh, okay.
So that's how I would look at that.
Okay. All right. Thank
Uh,
you.
I have a question.
yeah, sure.
Um, so I am very appreciative of this Turbo Tenant because I do have another software. It does not give as much as what you've just shown. But do you or can you recommend when you were calculating your depreciation? I think that's where I am finding that I have been cheating myself, but I
Hmm.
don't understand the calculations and how to get annually what I'm able to depreciate. So I haven't been doing that. Do you
Right.
have a calculator outside of your Excel, or did you just kind of learn the process and you created your own
I
Excel?
created this specific Excel for purposes of showing you all this, but I do have this Excel is pretty straightforward. I'm more than happy to take this offline. If you email me at taxes at Venure just to remind me, I'm taking notes here, but if you could just remind me, I can definitely share that resource. And if you want us to help you with that, we can as well. But I can definitely share that with you. If you could just email taxes at Venhere And I'm making a note here, depreciation for Quinet Excel. But yeah, if I go back to just very high level, if I go, because yeah, that will take a little bit of time. And for me, there's different depreciation methods. At a very high level, there's the straight method depreciation. That's what I'm using because it's simple. It takes the same amount every year that you can deduct. Very easy. You just need to keep track of how much you've taken so far and what years have you taken. There's other like accelerated depreciation where you're taking, let's say, 3 years worth of depreciation in one specific year. Now, some people may do that if they're doing like short-term rentals or if they're in the full-fledged like real estate kind of ongoing investment. They got like multiple properties. Each property's got its own LLC and all that stuff because they're going to have a higher income, right? And so they're using depreciation to help lower their taxable income. I don't recommend that. I always recommend keeping it simple unless you really are like in it for the long haul. That's when it really becomes advantageous. So straight line depreciation is what I use. That's what I recommend. It's easier to keep track of because it's the same amount every year. It's just literally knowing, okay, I'm in year 1, I'm in year 4, almost like an amortization schedule. And so that's what I could share with you. I'll do that offline. And yeah, just email taxes at Vendor, then I can remember.
Also, if you guys want to set up a meeting, our Wegmans meeting, if you want to do one of those like later this week or even tomorrow, because I know this is a lot of information for today, I'm very open. I'll just be on a fly on the wall because I give all my information to you ladies, and I'm not going to calculate any of this stuff. But it's helpful to have an understanding of what you're doing and why you're doing it. So I can do that for you too, if you like also.
Oops, sorry. I'm just sharing that. I was trying to find the chat thing while I was talking. So anyways, next slide so that we can finish up. We're almost done. So anyway, show and tell is the Excels that I was just showing and all that. The turbo tenant, like that's what I use. And I was really just trying to show the categories that are on Schedule E. That was the main purpose of that. It's a lot. It's a lot you can do. So, but depreciation is very powerful tool. And yeah, I'm going to continue using it. We're going to continue using it because it's a paper loss. It's not an actual like. Whereas the other ones were actual losses. Well, yeah, you're helping to get it back and all that stuff, but that one is like a paper loss. There's a difference there. So tax planning strategies, again, it involves you structuring your finances to reduce your tax liabilities. So if real estate is something you're interested in, I highly encourage you to pursue it because it could be a way to really imagine like you have rental incomes and you're paying like zero or close to very little taxes on that rent. That's very powerful. Whereas on the W-2, they taking that bad boy out, right? And the more you earn, the more they're taking out, right? And so it's a very powerful tool. The other thing with real estate is if you do it as a passive income or even active, there's no self-employment tax, which is really advantageous. When you do your online business or your side gig, you got to pay self-employment tax. So that alone right there is a massive savings, which is why certain people always use real estate as part of their wealth building strategy because especially if they're doing buy and hold for the long haul. If you're doing the short term fix and flip, that could be part of your strategy, but you're doing that really as a business, as a different type of business is what I'm trying to say. And that you still have deductions with that. You can still take advantage. But when you do long-term buy and hold, that's when you can take advantage of the depreciation because you're holding it for the long haul. That Excel had 29 years on it of worth of depreciation you can take. And if the mortgage is that, then it definitely has its advantages. So part of me and my husband's family, our family goal, we purposely set for certain, we're tackling our primary residence mortgage as a goal because the other one, the tenant is paying for that, right? So we're going to take depreciation. But our primary residence, we're attacking that as a goal because it's going to help us as we approach our I would say non-conventional retirement goal ages, where we will have lowered our cost of living significantly, allowing us to invest more. And we're still going to be able to take advantage of what the IRS rewards, which is investor behavior. Well, because we'll just have other investments, right? And what we had from our W-2 becomes another stream of income when we have traditionally retired and met the retirement age. So key thing here, pursue as many investment activities the IRS encourages that best fit your long-term goals. You don't have to do real estate, but if you happen to already own a real estate, please call me. I can help you. Okay. You can email me. Again, you can email taxes at Venn here to get a tax prep checklist and some of the resources mentioned, whether it's a turbo tenant link. And also, this is just going to be a little quick shameless plug here. I mentioned Venn here does other strategic advisory services. So if your career and things of that nature are interested in that, please do also talk to me. I recently also published a book. This was part of my doctorate dissertation, so I do want to just share that with family and friends. Help a sister out. I got to get some sales, with the publisher, but I will be pitching this to a lot of universities. It's entitled Ethical Leadership Implications of Leveraging Generative AI. We use that for other strategic advisory services. So if you're interested, check out our website. But otherwise, again, we've started this tax services really to just help our community. Yeah, we do charge a minimal fee, but it's not anything really compared to what some other places are charging. We really are trying to help folks just like, hey, this is a way you could really save a lot and use the savings for your own financial goals. So I hope that was helpful. Again, if you have a question, it's taxes at venhere.com. We'll get you situated. There's a lot you can do. And again, Quinette, I'll definitely follow up with you. But just, send me an email with the depreciation Excel. And then I also have a note for Candace for the tax contributions, the kind of the comparison of what's most advantageous.
I had
So,
one little public question, one little
Mhm.
last one that I think could be important for the group. And it was in regards to, oh my goodness, what is my own question? Oh, new home ownership, right? They make sure to kind of tell you more than a few times, you need to live here for a year. You need to live here for a year, for a year, for a year. And so I just wanted to know, like, how important that particular year is, what some penalties a person may
Yeah.
incur for, just not in their head saying, okay, but then, not
Yeah,
living
you do want to
there,
do that. Yeah.
leaving, and just some workarounds, legal workarounds to
Right. That
reach the
and that's a
guideline.
very good question, Candice, because at the end of the day, we want to stay compliant, right? We want to do things legally. Because the IRS will ask you when you do your taxes, it asks you what is your primary residence? Is this a primary residence or investment? So you have to differentiate.
Mhm.
Um, and so I would say you want to do your best to stay compliant. And that is a rule you want to, if you got the mortgage under the premise of this is my primary residence, you want to stay in it at least a year. That is correct.
Yeah,
Long story short, I'm answering your question.
thank you.
Any other questions?
I'm sorry, I got kicked off and then I came back on. So I do have one question. I actually am not utilizing all of the information you gave me, so this was very helpful. I'm appreciative. I've recently heard last year, I should have reached out sooner, but all of small businesses are now required in 2025. I think there was an extension to the 31st or yesterday for us to be registered with the federal government. Have you heard about that?
Yeah, I think it's called like BOI, Business of Ownership Interest or something like that. There was a lot of back and forth on that because they said, oh, it's required. If you don't do it, you're going to get a massive penalty. Then
Yeah.
they came back and said, no, never mind. It's no longer required. Then they said, no, it is. It's like going back and forth. So long story short, I can also take that offline with you. The last I had heard, it was not being required only because it was in the courts. So I am actively following that because a lot of people are really confused. There's been a lot of different, yes, it is required. Oh, no, it's no longer required. Yes, it is required. Oh, no, it is required. It's no longer required. And so that stemmed from FinCEN, the financial crimes under Department of Treasury. They're trying to track more of who owns what portion of the business, because they're track again, their reasoning is they're trying to say they want to track more financial crimes, people that are using shell companies, to hide taxes and do illegal activity behind the scenes and stuff like that. That's the reasoning behind it. However, there's been like a actual case fighting it because some people are saying this is against the Constitution, blah blah blah. I will circle back on that with you, but I have been tracking it. The last I heard is that it was in the courts and they were no longer requiring folks to do
Yeah.
that.
I heard that too, and I was just nervous because I'm like, the last thing I need now is a penalty, and especially since I know I'm
Right.
not using all these advantages. So,
Mhm.
okay, yeah, I heard the same thing. I just, always good to connect with other people to see what
Right.
they
Yeah,
know.
it's really kind of a strange thing. And I will just say to end all this, sorry, I said a lot. I was trying to make sure I get through all the info. Out of all the last survey that I had, let's look the last survey in 2021. I'll look at the one in 2024. But the last survey I saw, when it comes to statistics of being audited by the IRS, real estate was the least category.
I know that too.
So I'm not saying like the IRS is never going to audit you, but I'm just saying so long as you keep your books and you're following Schedule E, you don't have anything to worry about. Okay. But what you want to, if there's something that you're not sure of, that's where we're here as a resource, to reach out because we're doing something, we're sharing the service with folks, yes, for a fee, but it's something that we are actively doing. Okay. It's not anything that it's like, oh, I'm just charging this, but I don't know anything about it. Like we are actively doing it. So we're incentivized to look for those savings because we're gaining from it too. And it's a beautiful thing. You can earn $30,000 and I'm paying like $100 in taxes or something like that. I mean, come on, who wouldn't want to sign up for that? And I don't have
Right.
to pay self-employment tax.
I have a Venn,
Sign me up.
I have a Venn
Um,
here question.
yeah.
My Venn here question, because once I've shared this service, I got questions right away about how you do this service. And I see here that it says that you have a free portal. Is that
Mhm.
how people are submitting their documents for the tax
Correct.
preparation to
Yes.
the
Yep.
portal?
It's a secure portal. You create your own account and all of that. So that's how documents are being, uploaded into our system. And then we personally, I don't mind sharing, we use Drake software in case you're wondering. We have P10, we have EFIN actively registered with the IRS. So, and we also have, again, resources that have done taxes since, forever, taught me as well. And then CPA as well to review resources. So, yep, that is the onboarding process. It's through portal.venhere.com.
I'm gonna make my portal today.
Me too. Last
Yep. So
question for
that's pretty
me.
much it.
I
Mhm.
have last question. So you mentioned your book, and I'm very interested. Where can we purchase?
Yeah, sure. I just shared the link in the chat. It says kindlehunt.com. So you can purchase a copy there. It's an ebook.
Ooh, even better.
Yeah, it's an ebook. Part of that, again, we do strategic advisory services. This is just one of them with the tax planning and strategies. But there's a lot going on with AI. And so there was a lot of research that I did in terms of the ethical leadership implications, like what are organizations doing to keep people's information safe. And not only that, but it was all the way from startups to the White House. So I have different sections that touch on small business and how it's impacting minorities and small businesses. I had a section on large business because they're the ones driving the AI infrastructure. I'm sure you're hearing stuff on the news with, certain companies investing 500 billion in AI. It's really ridiculous. And if things are moving very quickly. So it's something that's going to impact everybody at all levels. And so, again, I was just sharing that since I was on the call, like, it is available now and I will be, yep, sure, I'll resend it in case someone missed it. And I will be actively pushing that forward this year too. It's one of our initiatives. So with Vend here, we do strategic advisory, and part of that is to approach universities eventually also government as well, because yeah, that's a different story. That's a different story. But yeah, universities, small businesses, it impacts everybody.
Thank you so much. Does this conclude your presentation?
It does conclude my presentation. I'm sorry I went over time there, but I did want to make sure I, answered all your questions.
Oh, we have questions and questions, but for the sake of the people holding on and everyone that wants to eat lunch, this will be the end of session one. I would love for you to let us know when you're having any workshops or any thoughts or anything that you want to express about topics that you're studying right now, like if you want
Mhm.
to come back and speak more about your book specifically and speak about AI and how we as regular people need to brace ourselves, whether we have a company or not,
Mhm.
or ways that we could get involved with AI ethically and
Yeah.
not for 500 billion, maybe, 200, 300. I don't know what the lowest buy-in rate
All
is,
right.
but ways that we can use it to our advantage and not to our detriment, like just like an AI class for the people. No pressure. You let us know when you're ready for that.
No
And
problem.
congratulations on your book. And then
Thank you.
there's some confetti here. Let me see some confetti. Did anyone find confetti?
I don't think it
Uh,
has it.
they have a
It's-
hat. I'm gonna do the hat. There's a little hat.
Thank you.
There we go, because we're still celebrating being able to call you Dr. Mandizvidza. We are so proud of you.
No,
Yes,
I appreciate y'all,
congratulations.
all of you, and that's what it's all for. It was to do that, and now, okay, how can I help folks?
I'm
How
gonna
can I give back?
need I'm gonna need about a day or so, and I'm gonna put this recording, online. We have a lot of people with schedule conflicts, but they're really looking forward to being able to go back and see this information later. And
Yeah.
also, if you are interested in investing in general and organizing your finances and your financial health, Dr. Rufaro's courses from last January, all three of them are there. And I know in real time we were all pumped up. We're going to do it. We're going to do it. Did you? So go back, and play Finances 101, course one, two, and three, and realign and regather and reestablish yourself. And then if you're having trouble, of course, you could reach out to her for professional help. And then one of our goals could just be to, when we get out of the end of this year, to really understand where we stand and to just be more intentional in how we spend and how we record.
Yeah.
So thank you so much. And
Thank you.
thanks for coming and have a great day.
Thank you.
Thank
Have a
you
great
so
day,
much.
everyone.
Bye.
Have a good one. Bye.